Section 5:2 Introduction to Modern Portfolio Theory. Portfolio optimization. Portfolio optimization techniques aim to construct an optimal portfolio by maximizing returns for a given level of risk or minimizing risk for a desired level of return. Two widely used portfolio optimization techniques are mean-variance optimization and the capital market line. Here's an introduction to both. Mean-variance optimization, MVO. Mean-variance optimization is a quantitative approach that seeks to find the portfolio with the highest expected return for a given level of risk or the lowest risk for a desired level of return. It was developed by Harry Markowitz and is a fundamental concept in modern portfolio theory, MPT. MVO takes into account the expected returns, volatilities, standard deviations, and correlations of individual assets within the portfolio. The optimization process involves constructing an efficient frontier, which is a curve representing portfolios with varying risk levels and corresponding expected returns. Portfolios on the efficient frontier offer the highest expected return for their level of risk or the lowest risk for their desired level of return. By considering different combinations of assets, MVO enables investors to identify the optimal asset allocation that maximizes return and minimizes risk based on their risk tolerance. Capital market line, CML. The capital market line is a graphical representation of the risk-return trade-off for efficient portfolios in the presence of a risk-free asset. It is derived from the efficient frontier and helps investors determine the optimal portfolio that balances risk and return. The CML starts at the risk-free rate of return and is tangent to the efficient frontier. The tangent portfolio is the optimal portfolio that combines the risk-free asset with a risky portfolio on the efficient frontier. The weights assigned to the risk-free asset and the risky portfolio depend on the investor's risk preference. The CML provides a linear relationship between expected return and risk, where portfolios above the CML are considered inefficient because they offer lower returns for a given level of risk. Conversely, portfolios below the CML are also inefficient as they offer higher risk for a given level of return. The CML helps investors identify the optimal allocation between the risk-free asset and the risky portfolio based on their risk tolerance and desired level of return. Both mean-variance optimization and the capital market line are based on the principles of diversification and risk-return trade-off. These techniques assist investors in constructing efficient portfolios by considering the relationship between risk and return, as well as the correlation among assets. However, it's important to note that these techniques rely on several assumptions, such as the accuracy of expected returns and the stability of correlations, which may introduce limitations and potential challenges in real-world applications. Optimization models provide a quantitative framework for constructing efficient portfolios based on specific risk and return objectives. By utilizing optimization techniques, investors can identify the optimal asset allocation that maximizes returns for a given level of risk or minimizes risk for a desired level of return. Here's an overview of how optimization models can be used to construct efficient portfolios, define objectives and constraints. The first step in utilizing optimization models is to define the objectives and constraints of the portfolio construction process. Objectives may include maximizing expected return, minimizing risk, as measured by volatility or downside risk, or targeting a specific risk-adjusted performance metric such as the Sharpe ratio. Constraints could include factors like target asset class weights, investment limits, liquidity requirements, and regulatory constraints. Input data. Input data for optimization models typically includes historical returns, volatilities, correlations, and other relevant statistics for the assets under consideration. This data serves as the foundation for estimating expected returns, volatilities, and correlations, which are key inputs for the optimization process. Historical data can be supplemented with forecasts or expert opinions, depending on the availability and reliability of such information. Construct the optimization model. The optimization model utilizes mathematical algorithms to identify the asset allocation that optimally balances risk and return based on the defined objectives and constraints. Mean variance optimization, MVO, is a commonly used approach, which incorporates expected returns, volatilities, and correlations to construct efficient portfolios along the efficient frontier. Other optimization techniques, such as risk parity optimization or stochastic programming, may also be employed depending on specific requirements. Solve the optimization problem. Once the optimization model is constructed, it needs to be solved to obtain the optimal asset allocation. This involves applying optimization algorithms to find the weights for each asset that maximize the objective function, example, maximize return, minimize risk, while satisfying the specified constraints. Various optimization software and programming languages are available to facilitate this process. Analyze and implement the optimal portfolio. After solving the optimization problem, the results provide the optimal asset allocation for the portfolio. The analysis involves examining the weights assigned to each asset, assessing the risk and return characteristics of the resulting portfolio, and evaluating its alignment with the investor's risk and return objectives. Once the optimal portfolio is determined, it can be implemented by adjusting the actual holdings to match the target weights, monitor and rebalance. Efficient portfolios need to be regularly monitored and rebalanced to maintain their desired risk and return characteristics. As market conditions and asset performance change over time, the portfolio's composition may deviate from the optimal allocation. Rebalancing involves adjusting the portfolio weights back to the target allocation, which helps ensure that the portfolio remains aligned with the original optimization objectives. It's important to note that constructing efficient portfolios using optimization models involves certain assumptions and limitations. These include the accuracy of input data, the stability of statistical parameters, and the reliance on historical information for future expectations. Additionally, sensitivity analysis and stress testing can be applied to assess the robustness of the optimization results under different scenarios. Utilizing optimization models to construct efficient portfolios can enhance the decision-making process by providing a systematic and objective approach. However, investors should exercise caution and seek professional advice when implementing optimization models, as they require expertise in data analysis, modeling, and interpreting the results to effectively meet individual investment objectives.